With chaos at the New York Stock Exchange.
Get back in there at once and sell!
We are looking at major records for the Dow.
Now is the time to buy.
Well, the law of gravity hit Wall Street today.
We're down by between 3 and 4.5%. The stock market is now down 21%.
Because we're now down 43%.
What in the world is happening on Wall Street?
You gonna do something or just stand there and bleed?
The whole town's gone crazy.
Hello and welcome to this week's edition of the Big Money Report. I'm your host, David Booth, President and Financial Advisor at BIG Investment Services. That's BIG, Booth Investment Group. We're full-service financial advisory based out of Dover, Delaware, serving clients all across America. And you can read all about us at abigplan.com. That's www.abigplan.com. I like to put the show together once a week just to give you a recap of the week behind and a peek at the week and weeks to come, trying to keep you up to speed with you and your money. And we're glad you're with us today. It is Friday, 2/2/24, February 2nd. Sometimes folks ask me, David, you do the podcast every single week. Do you ever take a vacation? Well, yes, I do. As a matter of fact, this podcast is coming to you from the Bahamas. I am on vacation. In my business, you're never fully on vacation. When you manage people's money, you just can't unplug and check out. So when I travel and do things, I'm always plugged into what's going on. I work when I'm away, but I work a little bit less if I can, if the market's not too crazy. And I do the podcast. I bring my setup with me. So yes, I do take vacation. I'm on one now and enjoying it very much. But let's go ahead and talk about the markets and what's going on with that. So Dow Jones up 1.4% this week. The S&P 500 up 1.4 as well, up 1.38. NASDAQ up 1.1. The Russell Small Cap Index down a bit, down 0.7%. Russell Small Cap Index just can't seem to really get traction. And the reason for that is interest rates. I'm going to circle back around. We'll talk about it in a minute. It's something that we talked about coming into this year. It seems to be playing out as we expected. So we'll talk more about it here. Volatility index, the VIX, we like to watch that, up 4.4% this week. Long-term bonds as measured by the TLT, up 2.4% this week. So they moved up a little bit higher. And when we take a look at the sectors, kind of a mixed bag. Energy was down a bit. Financials kind of flat. But some of other areas like consumer discretionary up 3.2% this week. You can kind of thank Amazon for that. You take a look at communication services up 2.6% this week. You can thank Facebook for that. Facebook, that's one we have in our models. Meta, it's Meta now, up 20% today. Really ripped higher on the back of its earnings report, announcement that they're going to start paying a dividend and additional $50 billion in buybacks. So that stock really ripped higher. Consumer staples are up 2.1. Like I said, just kind of a mixed bag. Technology as a whole was only up 0.2%. Gold was up 0.8, silver down 0.5. So what's going on with the markets this week? Well, we are in the thick of earnings season. Okay, so that's number one. And it's been interesting. We had a couple holdings earlier this week that reported. Google, also known as Alphabet, and AMD, a chip company that I like a lot. Interesting, they both reported good quarters, but the market looked for whatever little reason it could find to do some trimming. And I understand why. I mean, AMD is up 20% year to date. I mean, this is just 1 month into it, right? So when you have stocks that are up a lot like that, the markets will look for any reason it can find and maybe do some trimming. So little things out of the earnings reports that the markets took to try to use as a reason. With Google, their ad revenue didn't grow as much as expected, even though they beat top and bottom lines and things like that. The market looked for reasons to do some selling. I mean, Google was down like 7% the day that it reported. But then you look towards the end of the week and it bounces back. Same with AMD. It was down a bit the day it reported and then it bounced back. So I'm seeing the market just vacillate a bit. It looks like a lot of computer algorithms and traders looking for reasons to buy or sell some of these things, not necessarily being driven by longer term fundamentals. So that was the earnings front. I think overall earnings have been okay. I did do some reading on the breakdown of earnings expectations. You might remember we talked a bit about that last week. The market doesn't really care for what you've done for me lately. The market cares about what you're going to do for me next quarter, next year. and so forth. So when earnings expectations are weakening, the market sometimes weakens as well. Well, earnings expectations have been weakening at a lesser rate. That's a good thing. But when you drill down into that, it looks like financials have really been one of the bigger culprits for the overall S&P 500 expectations. So in other words, there's certain other areas of the market, certain other sectors of the market, their earnings expectations are dropping a little bit more severely than anticipated. And areas like financials are dropping much less and making a really big impact on the overall number. But I think the drill down is important. We're overweighted right now in financials. I think they look very attractive. We got three. We got Bank of America, U.S. Bancorp, and Schwab. I like all three. I think they're attractively priced, paying good dividends. I think it's just a good risk-reward setup right now. So just kind of throwing that out there as far as the expectations for earnings moving forward, because one of the things coming into this year that we said we were a little concerned about is the market was expecting pretty significant earnings growth. And I'm not so sure it's going to get what it's looking for. And that just might mean that this year's returns may be a little bit more subdued than people are hoping for. I still think it's going to be positive, but they might be more subdued than people are expecting. The other big news this week is the Federal Reserve and economic data. So the Fed had their meeting and the Fed disappointed the market. Look, if you read our newsletter, if you listen to the 2024 outlook for the market, the biggest risk that we saw for market volatility was not recession. The biggest risk was the Fed keeping rates higher for longer. The inflation maybe not coming down at the rate that they wanted it to and keeping rates higher for longer. And interestingly enough, the economic data has been good. The Fed had their meeting. They said, no, forget about March. As a matter of fact, we told you, forget about a March rate cut. We've been saying that pretty adamantly. The market was way ahead of itself, expecting the Fed to start cutting rates in March. And the Fed pretty much said so this week. Forget about it. And the market had a temper tantrum. I mean, the Dow was down 300 points a day. It's a pretty ugly day. Now, it recovered here towards the end of the week. But again, moving forward, I think this is going to be the data point that is probably going to be the most likely one to cause some serious market gyrations. And as we've said, I don't think this is going to cause some sort of major issue. It's just going to cause volatility. The second big piece of news this week, or third piece, we talked about earnings, we talked about the Fed. So the third piece, I can count. The third piece of information was economic data. Today, we got the January jobs numbers. And oh, wow. I mean, no one expected this. The jobs number was more than double expectations. Economists were looking for 160,000 new jobs, 355,000 new jobs. It was a blowout number, double expectations. And then on top of that, now here's what I'm concerned about. On top of that, we also saw significant hourly wage increases. Okay, now that is a potential problem. Inflation is driven by too much money chasing after too few goods and services. So when wages are rising, people have spending power. And sometimes rising wages can correlate to more inflation pressures. And that's one of the things that I think is just kind of hanging out there in the background that could be a challenge for us moving forward, something we're keeping our eyes on. But look, I tell you one good thing about this news. You can't say recession's around the corner. I mean, just there's no way, folks. You don't get a recession with jobs numbers like this, with unemployment like this, with wage increases like this. Just not something that's going to happen. So again, I think our base case is that recession is more likely end of 25, maybe into 2026. We're not expecting it this year, and the data seems to be proving that out at this point in time. So those are some of the things going on, things that we're watching. Of course, interest rates move on that news. Interest rates went higher, and as such, small caps kind of underperformed a bit here towards the end of the week because they're a little bit more sensitive to that. But again, we made some changes to our small cap exposures, and I like what we have there because we're really focused on companies with the highest free cash flow yield, and that's really important. Those companies are not so dependent on loans and financing to be successful. As a matter of fact, they're not dependent practically at all. So with that, they should be more stable even if interest rate pressures continue. So those are the things that I have for you. I mean, moving forward, we got more earnings are going to be coming out and the market will react and digest. I think it's been pretty resilient in the face of the news that's been coming out and the things that have been happening. But I think that our expectations for what's going to move markets this year are starting to really show themselves to be on point as far as for this point in time. And of course, that changes, will change as well. But I like where things sit right now. So I'm going to go ahead and wrap up. Between now and next week, as you're thinking about your future, your long-term goals, all the things you want to do with you and your money. Maybe it's buy that second house. Maybe it's come hang out with me here in the Bahamas for a week. Maybe it is put that kid through college or pay for that wedding or buy that RV, whatever the case may be. You know what your goals are. Don't just think about them. Think big. Think BIG. And I will talk to you next week.
Thank you for listening to this week's edition of the Big Money Report with your host, David Booth, President and Financial Advisor at BIG Investment Services. For more information on BIG and how you can access their planning and investment management services, visit them at abigplan.com. That's abigplan.com. Or call them toll free at 866-946-PLAN. That's 866-946-7526. The foregoing content reflects the opinions of David Booth and Booth Investment Group Incorporated and is subject to change at any time without notice. There's no guarantee that the statements, opinions, or forecasts provided herein will prove to be correct. Content provided herein is for informational purposes only and should not be used or construed as investment advice or a recommendation regarding the purchase or sale of any security. All investing involves risk, including the potential for loss of principal. There is no guarantee that any investment plan or strategy will be successful. Please consult a professional before investing.